The United States has just unleashed one of its boldest trade moves in decades. New 100% tariffs on a wide range of Chinese imports. It's a headline that sounds like something out of the early 2000s trade wars. But this time, the stakes are higher, the reactions sharper, and the consequences far more unpredictable. From Wall Street traders to small business owners, the ripple effects of these new duties are already being felt. Prices are shifting, supply chains are scrambling, and global markets are watching nervously as the world's two largest economies square off once again. So, what exactly is happening? And why is this tariff shock so significant? Let's start with the basics. The new tariffs target several key sectors: electric vehicles, batteries, steel, semiconductors, and certain consumer electronics. The Biden and Trump administrations both flirted with aggressive tariffs in the past, but this latest round, now formalized under the current administration, represents a doubling down of economic protectionism. The policy is designed to counter what Washington calls unfair trade practices by Beijing, state subsidies, dumping of cheap goods, and intellectual property theft. In short, the message is clear: the U.S. is done playing nice. But there's a reason markets are rattled, because tariffs don't just hit China. They hit American companies, consumers, and investors too. When a 100% tariff is applied, it effectively doubles the price of any imported Chinese product. For businesses that rely on Chinese inputs, from auto parts to solar panels, that means higher costs. Those costs don't just vanish, they get passed on down the line to distributors, retailers, and ultimately to consumers. Take the electric vehicle industry. Chinese-made EVs were already facing steep barriers to entry in the US market, but now they're practically priced out entirely. That's good news for American EV makers like Tesla, Ford, and Rivian, at least on paper. But here's the twist. Many of the components used in American-made EVs, like batteries, rare earth elements, and chips, still come from China. That means those costs are going up too. It's the same story in construction, manufacturing, and even consumer electronics. You might not realize it, but many American-made products still rely on Chinese materials or subcomponents. Tariffs don't distinguish between those. They raise costs across the board. So while the policy is meant to protect American jobs, it could also raise inflation pressures and squeeze margins for U.S. businesses. Now, on Wall Street, traders are calling this the tariff shock wave. Markets initially dropped as investors tried to price in the impact. Manufacturing stocks fell. Shipping and logistics shares wobbled. Retailers that depend on imported goods took a hit. Meanwhile, some U.S.-based industrial and defense companies saw their stocks rise as investors bet that domestic production would benefit. It's a tale of two markets, one side losing from higher costs, the other gaining from protection. But the long-term question is, will this really make America stronger or just more expensive? Supporters of the policy argue that this is a necessary correction. For years, China has used state support to dominate industries from steel to solar panels. By imposing 100% duties, the U.S. is trying to level the playing field, forcing American production to become competitive again and pushing multinational corporations to move supply chains out of China. And in fairness, it's already working in some areas. Companies have been shifting operations to countries like Vietnam, India, and Mexico to avoid tariffs. U.S. manufacturing investment is also rising, supported by tax credits and incentives from the CHIPS Act and Inflation Reduction Act. However, critics warn that this approach could easily backfire. China could retaliate with tariffs of its own, hitting U.S. exports like agriculture, aviation, and machinery. Farmers, who were hit hard during the last trade war, could find themselves caught in the middle again. And for consumers, higher import costs mean higher prices at checkout, from cars to electronics to everyday goods. Economists call it a lose-lose dynamic, one where both sides get hurt, even if one claims the moral victory. There's also the risk of global fragmentation. For decades, the world economy has been built on open trade and interconnected supply chains. But with each new tariff, that system breaks down a little more. Companies are now being forced to choose sides, either align with U.S. supply chains or with China's. It's not just about economics anymore. It's about geopolitics. For American businesses, this creates both risk and opportunity. On one hand, domestic manufacturers could see a resurgence. Factories in the Midwest and South are already seeing new investments as companies bring production back home. On the other hand, those same companies are facing higher input costs, labor shortages, and complex compliance rules. In other words, reshoring isn't cheap. What makes this moment different from the last trade war is the context. Back in 2018 and 2019, tariffs were a political tool. Now, they're part of a much larger strategic framework tied to national security, technological independence, and industrial revival. Washington isn't just trying to punish China, it's trying to reshape the structure of the global economy itself. That's why this tariff shock feels less like a temporary fight and more like the new normal. Investors, CEOs, and policymakers are starting to realize that global trade as we knew it, cheap goods, open borders, and limitless globalization may be gone for good. In its place, we're entering an era of economic nationalism, where countries prioritize control, security, and domestic industry over efficiency. The big question now is how businesses will adapt. Some will thrive by innovating and localizing. Others will struggle under the weight of higher costs. Consumers will face higher prices, but perhaps more resilient supply chains. The irony is that in trying to reduce dependence on China, the U.S. might also accelerate global inflation in the short term. Fewer cheap imports mean higher prices, and that could complicate the Federal Reserve's efforts to keep inflation under control. Still, policymakers argue the pain is worth it. They believe that a short-term shock is better than long-term vulnerability, that the price of independence is worth paying, even if it hits profits and pocketbooks. Whether you agree or not, one thing is undeniable. This is a turning point. The era of easy globalization is over. America is redrawing the rules of trade, and every business, from Silicon Valley to small-town factories, will have to adapt. The 100% China tariffs aren't just an economic move. They're a declaration of intent, a signal that the U.S. is willing to bear short-term pain for long-term power. The world's supply chains are being rewritten, and the new map of global trade is being drawn, not by corporations, but by governments. This is the new face of global business, one defined by competition, protection, and strategy. And as the tariff shock settles in, one thing is certain: the U.S. economy and the world economy will never look quite the same again.